Today is Monday, October 23rd, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, and Alan Bush, ADMIS Senior Financial Economist. Starting with the grains this morning, Mark, we had a long-awaited but brief breakout in corn prices last week. What triggered this?
Well, I think it was a combination of factors. For one, in last Monday's kickoff, I stated that I felt prices were going to grind sideways in this $4.70 to $5 range through month end till we get a better handle on South American weather. And so naturally, voila, 3 days later, we broke out to the upside. As you mentioned, the rally was short-lived, however, as D's corn peaked right at its 100-day moving average of 509.5. Speculative traders were fairly active on the buy side, reducing their short position in the marketplace. Demand-wise for corn, production for usage for the production of ethanol remains strong as margins have remained strong, and U.S. exports are running decent. They're up 17% over a year ago. However, the USDA is looking for a 22% increase, and farmer selling has been slow, and they're choosing to store their crops. That's pretty much what the market wants them to do with the big carries in the market. So I think we're pretty much right back to where we were a week ago, watching South American weather, looking for indications of a breakout. And I think we're finally starting to see conditions improve in South America, particularly in Argentina.
About crop progress this week, what are your expectations?
Yeah, I think we're going to see corn harvest advance to nearly 2/3 complete. My guess is around 63%. That's up from 45% last week. And that's just ahead of the historical average of 54%. We're probably going to get our last corn condition report tonight, and not likely to see much change from last week's, where we saw 53% of the crop in good to excellent condition. In soybeans, I look for harvest to have reached 81% complete, up from 62% last week and above the historical average of 67%. However, we've got some pretty heavy rains expected over the course of the central Midwest over the next 7 days. So we're going to be very concerned with the last bit of harvest, particularly across Illinois, Missouri, Iowa, and Wisconsin. We're likely to see some pretty good delays through month end now.
And Mark, we continue to see the index funds move assets out of the agricultural space. What will it take to make this stop or turn this around?
Yeah, we watch that pretty closely. We've seen net outflows by the index funds for 7 consecutive weeks and 10 out of the last 11. For the 10 commodities that I track in this space, assets, number of contracts held by index funds has now fallen to its lowest level since October of 2019. And I think it simply comes down to interest rates, with the 10-year Treasury note peaking at over 5% last week. And again this morning, that represents a 16-year high. So in order for us to see the outflows stop and maybe some inflows back in, I think we just need to see some indication that rates may have topped. And we'll also have some concern over the health of the global economy and its negative impact on consumption moving forward.
Interest rates, it's a beautiful segue here, Mark. Alan, looking at the financial markets, typically when there's geopolitical issues around the world, as worrisome as the current situations in both Israel and Ukraine, we see a flight to quality in the interest rate markets. Why are we not seeing this?
Well, normally you would expect to see a very substantial move into the flight to quality vehicles. The usual suspects would be the dollar index and the interest rate futures markets. And yet those two have really not performed very well. And in fact, the dollar has just been trading sideways, and the interest rate futures markets have actually made new lows. So as Mark mentioned, that 10-year above 5%, and in fact at 5.02%. So something is really wrong with the treasuries to not respond to the geopolitical events. So that in itself is a sign of weakness, and it suggests now is not a time to go bottom fishing in the interest rate futures markets. There's something wrong. Some analysts worried that there is a lot of government debt coming. Whatever the fundamental is, there's probably more weakness in store, especially at a time when you would expect strength.
And Alan, what is your outlook for the gold market? Here's another market which typically sees some flight to quality in times like these.
Exactly. So the gold market is the only flight to quality vehicle that it actually has performed as you would expect. In fact, it arguably has overperformed on the upside, briefly moving above $2,000 an ounce. So I think this is the market to focus on for a variety of reasons, not just a flight to quality issue. So the gold market performing very well, overperforming, and I think any breaks should be used as buying opportunities, and I think we can see a sustained move above $2,000 an ounce.
Lastly, Alan, how about a rundown on this week's potentially market-moving reports?
Okay, on Tuesday, we'll have the October manufacturing PMI guessed at 49.5. Wednesday, September new home sales guessed at 685,000. Thursday, September durable goods guessed at a 1% increase. Third quarter GDP predicted to be up 4.1%. And also Thursday, September pending home sales up 0.2%. And then finally, Friday, September personal income up 0.4%. And the more important October consumer sentiment index anticipated to be 63.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.